All right, folks, in this video, we're going to talk about the coming real estate nightmare, or maybe it's going to be a dream. Depends on how you look at it, and it's also really going to depend on whether or not you are prepared. That's why I love talking about the real estate asset class, is because it impacts everybody. So let me know in the comments down below what you think of the most recent real estate updates. Do you like the fact that we're switching it up a little bit from just XRP content? That's one of the benefits of the bear market, is you kind of have to find some time to, make some additional content when cryptos are down and nothing's really going on. Now, in regards to XRP, this is my first update since the proper party. It looks like it was just an absolute major success. Everyone had a great time, and we turned up and celebrated the fact that XRP is the only digital asset in the United States with clarity as in and of itself not being a security. And that in and of itself is a reason to celebrate. So I'm glad that the community got together. I would be lying if I said that I'm not slightly disappointed that we didn't get some major announcement. That would have been awesome. But nonetheless, it's great to see the community getting together. And another reason why I'm so excited to share this real estate update with you guys is everybody in the XRP community, everybody in crypto talks about, oh, after we go to the moon, I'm going to invest in real estate. After XRP goes to 589, I'm going to become a real estate investor and live on the beach. Well, unless you have a plan to actually execute that, strategy out, you're not going to be sitting on the beach sipping Mai Tais and living it up, without having a serious program, plan, strategy. And that's what we're putting together right now. So I want to keep you guys updated on the real estate asset class along with all of our current events, cryptocurrency, and we put this whole story together, and that's how we take advantage of the greatest transfer of wealth in world history. Now, we're taking a look at the situation here in the United States. The U.S. government is now just 24 hours away from a shutdown. Speaker of the House McCarthy just said that a bill passed by the Senate is dead on arrival. Today marks exactly 4 months since the debt ceiling crisis. Since the end of the debt ceiling crisis, the U.S. has added $3 trillion in debt and is about to shut down. What do you call the U.S. government? What do you call it when the U.S. government nearly defaults and shuts down within a 4-month period? I would call it an unsustainable path towards our own demise. That's what I would call it. Now, Congressman Byron Donalds has absolutely been laying into Gary Gensler. Absolutely love to hear that. But here he is at Capitol Hill making his case for, how ridiculous it is that Washington wants to just continue to grow and expand our deficit spending. No one wants to cut. No one wants to rein it back in. And then we want to continue to sell our children's futures away in the name of making everybody feel good and happy right now. So let's listen in here on what Byron Donalds has to say here.
Thank you, Mr. Speaker. $2 trillion deficit, $33 trillion in debt, and Washington just wants to continue to grow. 20% inflation year over year, crippling every family in our country, and 8% mortgage rates, squeezing our real estate market. And Washington just wants to grow and grow. Our cities are overrun with migrants because of the reckless policies of the President of the United States, and fentanyl is killing 85,000 Americans year over year. And the congressional Democrats refuse to secure the border. Thank you, Mr. Speaker.
That's pretty incredible stuff.
$2 trillion deficit.
That's pretty incredible. Now, what I like about Byron is he says it like it is. There's no dancing around here. There's no DC dance with Byron Donalds, and I really respect that. I like the fact that he says 20% inflation year over year. That's the real inflation, right? We're running with folks, in the economics talking heads telling us that it's 3%. It's not the case. Anything that matters is well over 10%. Most of it's 20% plus. And some of the things that matter the most, some of the stuff that they strip out of the CPI, right? And the way that they track inflation is our energy, is the cost of housing, is the cost of food. And you're seeing right now that energy's ticking back up, oil's back up. Once again, 8% mortgage rates. This is what we're about to get into here in the real estate market and the real estate update right here. Now, this is alarming, folks. And this is something that we haven't seen. This has happened only 2 times since 1975. And the only other instance has been the Great Financial Crisis. What am I talking about? Bank credit growth has gone negative for just the 2nd time since 1975. The only other instance being the Great Financial Crisis. Now, why is this so much worse than every other time this has ever happened? Because historically, bank credit declines into but bottoms after recessions. Okay, so that means that we are going down, we are declining, but we bottom after a recession. Well, we did have a recession last year. Nobody wanted to call it that. And so we should have a recession marked right here because we did have 2 quarters of negative GDP growth, but it was politically incorrect and folks might have been offended and cried if we called it a recession. So God forbid we do that. But what we see right now is that the bank credit is declining, but it doesn't bottom after a recession. We've already gone negative. See, it started declining during the Great Financial Crisis while that was going on and then bottomed after, just like it did in every other recession that we've had going back to 1975. But now we are declining and we've gone negative for the second time and we still haven't bottomed out. Now, this is a sign of the credit crisis, right? And this is when we say the debt crisis, this is what we mean. There's so much bad, toxic debt out there, plenty of in commercial real estate, plenty in mortgage-backed securities that are on the balance sheets of these banks, and it's leading to negative balance sheets of Bank of America that has unrealized losses of over $100 billion on their mortgage-backed securities and their bonds. And so now we're starting to see the credit crunch arriving. Bank credit is declining, but it bottoms after a recession. Now, we have a long ways to go unless we're going to get a recession here next year, right? Which is very likely. But my speculation is that they're going to try to paper this thing over, and the GDP data that they're giving us is an absolute joke. I was just looking at Canada's GDP. It's less than 1% this whole year. Every single month, there's been a few months where it's actually like 0.1 or 0.0. Guys, that's death. That's death. Let's be real. Let's be honest, okay? And everywhere outside the United States is in an even much worse position when it comes to real estate because they don't have 30-year fixed. See, in the United States, we are blessed with the 30-year fixed mortgage, especially with the FHA loans where you can put down, 3%, no money down. That doesn't exist in other parts of the world. And that's why other parts of the world are going to experience a much deeper housing crisis and recession and nightmare, as I titled this episode. And when we look here in the United States, it's not very good either. The housing market continues to get worse. Pending home sales just fell to their lowest level in history, significantly lower than during the worst months of the Great Financial Crisis. Mortgage rates are now over 7.6% and likely to break 8% before the end of the year. There were about 50% fewer homes for sale last month than in August of 2019. That is way less. What do you think will happen to home prices once inventory begins to normalize, right? So inventory's way, way down, right? And this is part of the reason why prices have stayed up. But pending home sales are starting to fall off. And the reason why that's so troubling, right, is because we have so much new construction. And that's a big part of what's kept prices propped up and kept home sales propped up, is that the builders have been able to do rate buy downs. Now, as we see these builders finish off this construction, bring all these properties to market, right? When we have interest rates above 8% for the mortgages, right? Unless they're able to do rate buy downs, they're going to eventually have to drop prices on these in areas where they've overbuilt. I want to reiterate one point that I always have to say in all of these real estate updates. This is a market by market basis, right? New York's real estate market is much different from Kentucky's real estate market, right? Seattle, Washington, much different from Missouri. Shout out to our folks down in Missouri, but got to make fun of the Missouri folks. San Francisco ain't the same as the Midwest. You get my point, okay? So when I'm talking about a real estate crash in the cities, it is death. It is carnage in the cities. The Midwest probably appreciated a few percent this year and is doing just fine, okay? So understand when we're talking about real estate and this whole market dynamic, this is going to depend on a case-by-case basis, on a market-by-market basis. But overall, it's not good. U.S. housing market affordability is by far at its lowest point in history. Even in the worst part of the 2008 financial crisis, affordability was about 15% better than its current levels. So when we go back and look at everything compared to 2008, it's all worse or equivalent, right? And everybody says this time it's different. This time it's not just real estate. Exactly. That's why it's so much worse. This time it's an everything bubble. Don't you get it? Yeah, this time it's not just real estate, it's everything. We're all going to die. With the recent move higher in Treasury yields, we should see about 8% mortgages within a week or so. Yeah, it's going to be coming here soon. And once again, the Fed is leaving another interest rate hike on the table as well, some point this year. Now, this also means that the median home payment will soon cross $3,000 a month for the first time ever. So, guys, can you imagine that? The median home payment is about to cross $3,000 per month for the first time ever. I think it's at like $2,800, almost $2,900 right now. Home buyers are now spending 50% of median pre-tax household income on house payments. Now, that's pre-tax, which depending on what state you're in, depending on your income bracket, right? You're handing over a third or half of your income to the government at this point. Buying a house is now a luxury, and this is why we're seeing the pending home sales fall off. This is the demand is at the lowest level, the housing affordability lowest level in history. This is not good, and the reason why I want to keep on putting out these updates is to make folks aware, understand what you need to watch out for, because the real estate industry has been predatory in the past, and I'm not saying that everybody's a bad apple, right? One bad apple doesn't ruin the bunch, okay? But there's plenty of stuff going on that was going on in the past, and the practices and the lending standards have gotten much, much stricter this time, but we're starting to see the easing. We're starting to see the 0% down. Where I even saw Bank of America was offering, if you're depending if you're the right race, ethnicity, or color, you can get 0% and no closing costs. And all these sorts of programs are coming out to incentivize folks to come in. And now I wanted to share this with you. John Downs, mortgage advisor, shares that he had just watched a mortgage industry coaching platform video highlighting a loan officer's, quote, winning strategies in today's market. Here is what I heard. And this is what you need to watch out for when you go to buy a home. Okay. They are telling folks, show the client our conviction in rates dropping and refinancing in the next 12 to 18 months. Every single person that I have talked to in the real estate industry, property managers, brokers, mortgage brokers, real estate brokers, you name it, everybody is telling me just buy now, refinance later. Every single one of them. Now, do I agree that rates are going to go down? Yeah, I do. And the consensus on Wall Street is that rates are going to go down. The consensus in the Fed is that rates are going to go down. But what are they going to go down to? 4.5% to 5% Fed funds rate, down from 5.25% to 5.50, which is where we're at right now. 5.25% to 5.5% interest is where the Fed funds is at now. And they're pricing in cutting down to just below 5%, maybe 4.5% if we really get aggressive. Now, is the Fed bluffing? And maybe these guys will be right. Maybe the mortgage brokers that are sharing their winning strategies of pitching everybody, buy now, refinance later. Maybe they'll get lucky. Maybe it'll work. We'll get black swan. We'll get killed, and the Fed will drop rates back down to zero, just like they did during simulation events of 2020. In that event, financial tsunamis here like we've never seen before. So it's still going to be a dicey one, okay? But when it comes to these guys, right, they're not listening to what the Fed's saying. They're not accepting that inflation's much worse than what the Fed's leading us on to believe. So the fact that they're telling folks, show the client our conviction in rates dropping and refinancing in the next 12 to 18 months is incredibly dangerous. Showing low down payment financing 5% and then showing the future refinance at 4.875%. Right? So they're trying to get you the cost of waiting. If you wait until rates drop, prices will be higher. You'll save so much more by doing it now, which is, of course, a joke, right? You're banking, you're praying that you're going to get rates cut and that you're going to be able to refinance, but you have significant problems with that. Don't draw attention to the rate. Have the client focus on cash out of pocket and payment. Anything to get the client in the house and to collect your check. That is why they're called brokers. They are broker than you. Don't you get it? Mortgage brokers, real estate brokers, they're all broker than you, which some of them they're not. You know, some of these guys make some pretty darn good money, or at least they were, right? And the way that they pitch and give you financial advice without any sort of financial backing. Some of these guys are just slick-suited salesmen, fresh off the block, and it takes nothing to go get your real estate agent, your license. It's nothing. Now, label rate buydowns as lower payment or lowest payment, essentially avoiding the points discussion, right? You want to get them off this rate. Don't highlight how much interest you're going to pay. When you go to buy that median home at $500,000 or $600,000 and you're at a 7 or 8% mortgage, you're going to end up paying over $1 million on the life of that loan. Make sure you don't tell the client that, right? Make sure the client just focuses on that payment and that down the road we'll be able to bring that payment down. Trust me, bro. Rate buy down recapture. They compared payment savings to cash outlay difference versus including additional principal paid with lower rates. Every gimmick in the book they're trying to pull right now. More evidence that, unfortunately, most loan officers view themselves as salespeople. The idea is to come up with key phrases and sales pitches that move people through the sales funnel. There is another side to everything mentioned above that should be discussed because these points aren't all bad and could easily become true. I would have added. Well, no, they are bad. They are going to be wrong. I would say that, right? I would predict that. And once again, even if rates come back down, we need a historical correction to take place before we even come back down to reality or affordability, okay? And the other thing that everyone is pricing in, everyone puts into their grand thesis, or in this case, their sales pitch to get you to buy the house today, is nobody's admitting that we're in a recession. Nobody's admitting that it's going to get worse. Everybody's in complete denial about that. And that's why we're getting set up to go to the slaughter. Now, this gentleman right here, John Downs, I should say. John Downs adds this. This is what he would have added. Rates might not drop. In fact, refinance rates are dramatically higher than first-time homebuyer rates. Everyone is missing this story when comparing this inevitable future refinance. Right, rates might not drop. And as I said, the Fed's telling us they're not going to drop by much because inflation's not going away. It's not even close to going away. You also might not be able to refinance if you just put 5% down. Prices may plateau and push lower. The old days of no-cost refinances using lender credits may not come back for many years, meaning closing costs and real costs. Once again, when you go to refinance down the road, you're going to have to pay fees to refinance. You're going to have to pay closing costs on another mortgage. Plus, you need to have equity. And if that new home that you bought has now, all the homes down the road after you bought on the, you moved into the development first, and even if the builder bought down your rate a little bit, you probably still overpaid. And now down the road, Jim and Sally moved in and bought their house for $50,000 less than where you're at. Where are you going to come up with the equity? Where's your 5% down? It's gone. Nobody's pricing this in. Nobody's calculating this, right? It's like a business plan. Show me a business plan that's failed on paper. None of them do. Every business plan plans for success, yet 9 out of 10 businesses fail. That's the same process, same mentality, same thinking that's going into this calculation, into this sales pitch by the guy who's broker than you. Now, prices might not go higher as rates push lower. Every area is different, but lower rates in an environment of economic weakness and potential job loss could see prices remain flat to slightly down. Keyword could. It's a great point. In the areas where many people want to live, prices have been going up substantially, but they might just cool off because folks are happy outside of the cities, in the suburbs, right? All these areas that folks moved to, right? Sure, they might have to go back to the office. Some are going to have to go back to the office, but that doesn't mean that these boom cities from the pandemic are going to collapse. No, a lot of folks are going to still be there, right? And so we are seeing drawdowns in, cities like Boise, big drawdowns in cities like Austin. But once again, those are cities, made big cities, right? You look outside of there, the prices are still hanging in there. They've come down a little bit, right? But this is where you're seeing sacrifice in the cities, and you're seeing folks are just chilling out in middle America. Now, the alternative to buying, renting at a reduced monthly cost, area and property type dependent, while your down payment funds earn 5% in a money market, again, rarely discussed. That's a great point. So right now, and for me too, in my area, it's way cheaper to rent, not even close. And for most markets that are overvalued, it is way cheaper to rent. And there are folks telling you that you're going to miss out right now if you don't get in. Your cost to buy later is only going to go up. No, I don't need to build wealth. You don't need to build wealth through real estate, through owning your home that you live in. There are plenty of people that have made billions of dollars. In fact, most billionaires make their money in business, not in real estate. There's plenty of millionaires have been made off of real estate. Absolutely. I'm not discounting that. There's plenty of wealth that's been created off of real estate. But you don't have to. It's not the end all be all. And at the end of the day, the place that you're living in is mostly a utility. It's a liability until you've got that thing paid off, and then it's an asset. And then even if it's paid off, it might not be an asset because it's not going to put money in your pocket, right? See, something's not an asset unless it's giving you cash flow. So even if you got a paid off house, you still got to mow the yard. You still got to maintain the property. You still got to pay all the bills. That's still a liability, right? And so once again, I'm just fine renting right now. And I will share this real quick with you guys as I wrap up this video. For me, I'm remaining patient when it comes to my personal property. I'm fine renting. I don't need the white picket fence dream. I'm going to build a significant amount of wealth with or without owning the place that I live in. Not concerned about that in the slightest. What opportunities am I looking at? As always, utility. I'm a utility investor. Same thing with cryptocurrencies, the same thing with real estate. We need affordable housing. We need units that people are happy to live in. Folks don't necessarily want to do the coffin apartments. Are folks willing to move into an apartment? Sure. But they want a place that they're proud to live in. So I think that affordable housing, and there's many ways that you can skin that cat, but it all comes back to utility. The other opportunity is commercial conversion, taking properties that are not performing, that are dead, that are empty or vacant, and taking them and converting them into, utility that is needed. Affordable housing, maybe converting it into some other sort of commercial property that's going to be able to drive revenue from a different business model, right? You have a lot of properties that are just mispurposed, and you have to get them at a significant discount to make it worthwhile, right? So this is where I'm building out the relationships to help me move into the real estate asset class in a major way over the next year. Like I said, patience on my personal property. But when it comes to the investment portfolio, we are going to be getting extremely aggressive right now. Extremely aggressive. And we're going to start putting in our offers. We're going to start building out this portfolio and moving in an area where we know we can add value from day one. And like I said, utility never goes away. The utility is needed more now than ever. And that utility that's needed is affordability. People want a clean place to live. They want to be in a good school district. And there are still plenty of areas that need more units brought online. That's what I'm looking at. Let me know in the comments down below what opportunities in real estate you guys are looking at. If you're looking to get tapped in with our community where we talk about the deals that we're doing, please head on over to our Discord group. You can get access to that by going to my website, ZachRector.com. I'm about to actually go have our weekly Discord call every Saturday morning. We have our weekly Discord call, and I would love to have you join us in the family over there. I'm also going to be announcing our next in-person meetup. Really looking forward to that. And I got more exclusive content over there if you're interested. So that's all over at my website, ZachRector.com. On the way out, if you could please smash that thumbs up for me, hit that subscription notification bell, and I will see you guys in the next video. Thank you so much. God bless you all.